Hi there everyone and welcome to the market right here on ET Now. I'm Avan Dabash. With me is Anisha Jain. We're kickstarting a brand new month and well, yesterday you had the markets which actually snapped their 4-day gaining streak. But that aside, I think the big headlines are coming in from across the globe. The latest on the key congressional vote in the US debt ceiling, and Republicans control the House by a narrow 222 to 213 majority. But the deal will need support from both the Speaker Kevin McCarthy's Republicans and US President Joe Biden's Democrats in order to pass, as members of both the parties have objected to significant parts of that legislation. The procedural vote was passed by a vote of 241 to 187, with 52 Democrats needed to overcome the opposition of the 29 Republicans. How did the US markets react overnight? Well, it was a cut of about 0.5% on the Dow Jones, and for the most part as well, you had the Nasdaq as well as the S&P 500, which wrapped up the day in the red. In fact, for the month gone by as well, it's been quite lackluster for Wall Street, apart from the fact that the Nasdaq did manage to hold out for the month, largely on the back of the fact that stocks like Nvidia, Alphabet, Meta, Amazon, etc. had a pretty stellar month. But that being said, most of the Asian markets have started off mostly higher this morning, and you've got the SGX Nifty as well indicating at a bit of a muted start. So clearly, it's quite a bit of updates coming in. Next steps that are going to be watched out for is that the Senate must have to pass this bill before sending it to the US President, who will then sign it into law. But apart from these factors as well, the markets will not only be watching the debt ceiling battle, but will be looking ahead to the US Federal Reserve's June 13th and 14th policy meeting. That is also going to, Anisha, be a key catalyst when it comes to the global markets.
Well, yes, the FOMC meeting on June 13, 14, and of course we have the RBI meeting coming up in the coming weeks. So back home, that remains very, very critical to watch. But despite the fact that the US, Congress has passed that vote, we are not seeing a big jump up as far as the pre-market rates in the US are concerned. They continue to languish in the red. Having said that, as we pointed out, Asian markets have opened on the front foot, so that's something to cheer. The passing of the vote has not had a big impact on crude as well. Remember, overnight it saw a sharp cut of almost 4% coming in for crude. In fact, it managed to close at the lowest level since 2021 of December. So quite a bit of crack coming in as far as crude is concerned as well. On an intraday basis, of course, the 2023 low stands at around $70, but we went very close to that level, just around that 72 mark as far as Brent is concerned, and quite a few reasons for that. Of course, there is this entire demand worry coming in from China. At this point of time, the PMI data was quite weak, and that has led commodities to tumble quite a bit. You also have the fact that the US crude inventories are rising. So on one hand, you have demand which is slowing down, but enough supply coming in. Russian exports have also been quite steady, so we haven't seen any meaningful cut coming in there, and stronger dollar too is impacting the crude prices. Remember, over the weekend, there's an OPEC Plus meeting as well, which is lined up, and the street is worried that perhaps there'll be no production cut coming in. And that's the reason we are seeing that the crude prices continue to hover at lower levels. Of course, back home, they'll have an impact across a whole host of sectors. Of course, OMCs will see it positively because the marketing margins will gain. It's also positive news for the users of crude derivatives, the likes of paints, etc., tires, etc. So a lot of impact coming in, and overall crude, as we know, is a good news coming in for India, lower crude that is. So that's something to watch out for. In fact, on crude, we spoke with Chris Wood as well when he visited our studios. He said that he's expecting crude to settle around $70 to $75. Listen in.
Has the decline in crude prices delightfully surprised you?
Yes, it has this year. Yes, it has, because China was. The question on the decline in crude prices was seen: is that the oil market discounting a U.S. recession, or is it just something technical? The other issue is, why hasn't the oil markets, received more of a boost from the reopening of the Chinese economy? So on the latter, I believe the Chinese economy, the Chinese stocks are acting like the Chinese economy is collapsing, but actually the Chinese economy is not booming, but it's definitely, it's improving. So what I've heard on that is that the Chinese stockpiled a lot of oil during the last year or more. So they did opposite from the Americans. The Americans used up a lot of their strategic reserve, and the Chinese did the opposite. But the longer time goes on, the more we should get a boost to demand coming from China. So the real issue is, are we going to have a real recession in the US and Europe? Otherwise, the oil's weakness looks a bit strange.
You added
But anyway, India is obviously able to buy the cheaper oil. So that's been a huge positive, and that will continue.
when we spoke exactly a year ago, you added ONGC into your portfolio. You were bullish on Reliance, and that was a play on the oil cycle.
Well, it's partly a play on the oil cycle, but it's also just partly to hedge the risk that something happened geopolitically to cause oil to go to $150, which would be a negative. So I keep those two stocks in my portfolio. That obviously they were, since I was here, you had that windfall tax.
Yes.
So that's made these stocks less attractive than what they were before, because they're not as geared to higher oil prices as they used to be.
All right, let's take forward then the discussion. We've got with us Cameron Brand, Director of Research at EPFR Global, joining in on the show. Cameron, lots to talk about. So let's begin by just getting your take on the debt ceiling bill passing in the House. And you have the U.S. Secretary Janet Yellen actually saying that the federal funds could dry up in the coming days unless the lawmakers raise the borrowing limit before a week. Do you think the global financial markets are actually worried that there could be a failure to do so?
They certainly, through the lens that we watch, which is the mutual and ETF fund flows, they really don't seem very bothered by it. The pattern of flows is indicative of attention to a potential recession later in the year. And frankly, I think investors have been almost too unconcerned about the risk that this round of the debt ceiling negotiations could turn sour. There is, however, I think a lot of liquidity out there. The money funds that we track have absorbed over 600 billion so far this year. And we're heading into the mid-June estimated tax payments, which will bring a rush of money into federal coffers. So the situation, while it should certainly be treated with respect, is not, I think, quite as dire. I think Janet Yellen is doing a little bit of sheepdogging.
Situation is not as dire as it seems, and there is quite a bit of liquidity available. But the question is, Cameron, you track the fund flows also very, very closely as to how it's going into certain asset classes. What's the trend on the ground at this point of time? Is it still heading towards the tech stocks? Is there some move towards treasury as well? What's been the latest reading?
The four fund groups that have done really well, I would say, in the past 6 weeks have been U.S. money market funds, U.S. sovereign bond funds, China equity funds, and technology sector funds. Coming up on the inside rail, I should add for your viewership, India equity funds have seen very steady and increasingly strong inflows as well.
All right. That aside, then, what is the outlook then from the U.S. Federal Reserve in terms of their policy meeting? Do you think that that's going to be a key catalyst that the markets will watch out for, and what do you believe we could see?
I certainly think the markets are waiting to see what kind of guidance and/or action emerges from that meeting. I think at the moment the consensus is that they'll hold, but it's pretty unlikely that they will cut. But markets are certainly looking for the Fed to recognize that they've gotten on top of inflation and that the risks are now to economic growth in the second half of the year.
Okay, Cameron, on that note, we'll let you go. Thank you so much for joining us and talking to us about a whole host of factors which are at play at this point of time when the global arena is concerned. But back home as well, if you look at the Indian markets, we actually managed to snap the 4-day gaining streak yesterday. We ended in the red, given the global cues were quite weak on an overnight basis. In fact, it's the biggest decline that we have seen in 9 sessions. Having said that, the broader markets continue to participate with quite a bit of gusto because both the small cap and the mid cap index managed to end comfortably in the green, and the advanced decline ratio also wasn't looking too bad. The spaces which actually came under pressure included energy, metals, as well as financials. So energy and metals clearly impacted by what's happening across the globe, and the banking index has been a bit weak of late, so that was playing out yesterday as well. Pharma and IT surprisingly managed to buck the trend yesterday. Torrent Pharma we saw was sitting at all-time high levels. Some of the IT names also clearly saw a bit of a buying momentum, and the buying momentum is coming in from FIIs clearly, wherein they have been buying for the last 24 sessions out of 25. So that's something which has been playing out for the Indian markets as well. In fact, Nikunj is also joining us. Nikunj, this is exactly what we have been saying, that on a daily basis there might be up or down moon, but the momentum firmly continues on the upside for the market.
Nisha, frankly, if you look at the market internals yesterday, what are the internals you look at to understand the short-term direction? You look at FI flows, and including the block deals yesterday, they were quite robust. You look at the open interest addition on the long side, on the short side, that is not anything which is telling you that we are nearing a trend reversal. So then why markets in a sense yesterday did not take that giant leap forward closer to make an all-time high? Aisha, Nisha, typically what I've seen is that before an all-time high is made, a lot of give and take happens. The same thing happened with Bank Nifty. It almost went to an all-time high, came right back up, and then one good day, little bit of news flow, and it could that number was taken out. One. Second, Reliance has just not participated. So if you frankly look at the market from the prism of Nifty, and if you take Reliance out of the equation, I think markets were okay. There was mild profit booking. Some of the high-flying stocks which are now dominated by China investors, I think they did rather well for themselves. The markets are rotating beautifully. Look at, let's say, an Indian hotel or a Zomato, or for example, some of the manufacturing companies, defense stocks. So markets are rotating beautifully. I think to really look at the market from the prism of Nifty, I think would be a bit unfair. And within that, if you really take out Reliance, I think the market will look very, very differently. So it's a purely view, Anisha, which matters, that how are you looking at the market first. Second, when you are in such a pronounced, strong uptrend, one day out, it's not going to change the big picture. The big picture is that FIs are back. The big picture is that the concerns are getting arrested. The big picture is that earnings have been strong, and that in a sense is now getting endorsed with the GDP data. I mean, the GDP data is again and again indicating and endorsing the kind of template markets are working with. That template, I think, is not getting challenged.
Off the GDP print as well, it did beat street estimates, with that GDP data coming in at 6.1% in the last quarter of FY23, with a full year growth of 7.2%. So clearly retaining the fastest growing tag. So given the fact that all of these factors, Nikunj, are stacked up, the fact that FIIs have been supportive, earnings as well have been fairly decent. Going ahead, we are going to watch out for the RBI's rate reaction, as well as a view on auto sales. What do you think that the street is going to keenly watch out for in terms of the next cues?
For me, the suspense of this time's credit policies are already out. I mean, Reserve Bank of India governor, I think last week he did indicate that where GDP is headed and where inflation is headed. He expects the main inflation to be low, and he expects the GDP print to go closer to 7%. So you pretty much know that Reserve Bank of India, I think, is now in that sweet spot. They've managed to tame inflation down. They've managed to take growth. I mean, and growth is recovering its natural course. That's one. Second, if one really looks at the other factors which may really influence credit policy, where is the monsoon headed? Well, the progress has not been bad at all. I mean, I can complain about that, this time around there are some erratic weather patterns in north. I mean, Delhi, I've been told this year when I landed here, it was actually raining and there was no summer. So there are some seasonality factors that play in North India, so that may have an aberration in terms of the overall monsoon distribution, but that time will tell. So I think from a credit policy standpoint, the stance. It is not a pivot, it's a pause, but you pretty much know that directionally how things are stacked up there.
pivot, but it's a pause. But the reading, as we pointed out from GDP, was quite strong, though most of it was actually coming in from capital formation. It was the private consumption that lagged a bit. So that's something that the economists are worried about a bit. But the numbers reflected in the chief economic advisor V. Ananta Nagasevaran's optimism, as he said that India can look for another year of solid economic performance. The CA also added that the risk to the projected 6.5% GDP number is evenly balanced, and there is a good chance of this number may be exceeded in FY24. Listen in.
Right is at its highest in about 8 years at 23.5% of GDP. And the private consumption to GDP ratio is again at a high in the last 16 years. And gross fixed capital formation, while it is 34% of GDP, specifically looking at the fourth quarter, year on year, the share of GDP of GFCF, gross fixed capital formation, was 35.3%, and in nominal terms, it was 31.7%. So overall, as we have been saying that the government's investment in infrastructure over the last several years is beginning to crowd in the private sector investment, as you can see in the new project announcements and also from the data released by companies on their own cash flows.
Okay, let's move right on then and focus in on the markets and levels to track. We've got Naresh Marani and Kunal Bothra, our chartists, joining in. Kunal, let's get in a take from you. We're kickstarting a brand new month. After all that's transpired, what's the outlook for the month of June? Do you think that we're going to scale those new highs soon, and when?
Well, I think the start seems to be a bit iffy for the indices because we were expecting the momentum to continue for the index both on the Nifty and Bank Nifty. But I think yesterday's trading session gives an indication back again that the markets are not ready for a very strong kind of an breakout, but it would be more of a staggered up move for the indices, where after a up move of 200 to 50 odd points, we could probably go into a pause of at least another 4-5 trading sessions before we manage to scale up higher. So I think if that's the landscape, possibly by the second half of the month of June, we can expect the index to come back towards or come closer to the previous all-time high levels and possibly go past beyond that. So I think the setup across the globe, the setup in terms of the data points is quite positive for global equities. Nifty has also managed to come back to that 18,400 plus mark, which was the resistance for the index. There was just one data point which was seen yesterday in terms of unwinding of positions, where I think on the Nifty there was a 7% to 8% drop in the open interest. That indicates that maybe there could be some bit of profit booking on the long side, which has happened onto the indices yesterday. So that's the only change of data point. But other than that, I think the view remains positive. 18,400 could be a fresh support. Keeping that support as a major critical point, I think traders can hold on to their long positions.
The view remains on the positive side, even though the all-time high levels might be coming towards the end of the month. At least that's what Kunal is suggesting. But Naresh, are you worried at all about the underperformance coming in from the banking index?
Not really. So what we are seeing is, if we look at the banking index, it is more due to the fact that the largest rate, HDFC Bank, has not moved up. The stock came down from 1730 on the higher end, which it made all the way down to 1600 odd level. So that is down 8% from the top roughly. And that is not the case with the rest of the banking names. We've not seen a similar dip in any of the banking names. So what it looks like is we are getting into a consolidation. We want to get into a new high, but the new high on the Bank Nifty is only sustainable if a majority of its constituents actually make a new all-time high. So if you were to compare it, HDFC Bank has not made a new all-time high. Kotak Bank is far away. ICICI Bank came close to it. SBI is far away. So out here, what happens is we've not seen 52-week highs, all-time highs in most of the banking names. So it's been a rotational move in the banking names. So that does not create a clean breakout. So we could be classically pausing here around this 44,000 plus minus 500 points before we can make the next move towards a new all-time high in momentum. So overall, expecting a range-bound move for the Bank Nifty, 43,500 to 44,500. Similarly, on the Nifty, it would be 18,400 to 18,700 for now. But the bias remains positive. The focus is to be more stock specific rather than looking at an index trade as of now.
Let's nail it down to those stock specific calls then. And Kunal, given that it has been a lackluster start, what's the outlook in terms of individual stocks that could light up the screen?
So from the FMCG pack, I'm picking up Dabur as a first trade. Very interesting breakout, inverted head and shoulder pattern, inclined inverted head and shoulder pattern for Dabur on the daily charts, breaking past above the 50 DMA. The stock has been an underperformer, so I believe that there could be a strong play of a catch-up for Dabur even from current levels. 585 could be a target which short-term traders can keep an eye on. Stop loss for this trade is 540. And the second would be a buy on PNB, Punjab National Bank. Again, a stock which has confirmed, which had confirmed a breakout in 2022 second half, then gone to a consolidation / correction, but now it's making a comeback. I think at 50 plus levels, the stock has also confirmed a swing breakout on the daily chart. So would suggest a buy 56 as a positional target and stop loss at 48.
All right, let's find out what Naresh as well has picked out as his stock-specific strategies. Naresh?
So first is a buy on Bharat Forge. The stock has made a good enough consolidation, a classical double bottom in the short term around that 750, 760 mark. Over the last, if you look at the long term from 2018 till date, the return comes out to zero. The 2018 tops were around 750, 800. The stock tried to make this breakout above 800 mark, went up to 900 and then flopped out. So that was a false breakout. Now again, we could be starting up a new trend. In the short term, it has made a double bottom around 750, 760. The interim highs are 810. Once that breaks, that would be a confirmation. The last 3 days, the stock has seen a small breakout of a trading range, expecting it to eventually break 810 and go towards the 900 mark again. A stop loss to be kept at 770. Second is a buy on Biocon, a stock which went from almost 480 levels to 200 levels. It actually broke below the March 2020 lows, which were around this 240 mark. And now after, say, making that bottom around 190, 200, the stock has recovered back above the 240 mark. And now 240 was a resistance for the last few weeks. The stock has sustained above the 240 mark. On the result day, the stock saw a spike to 255, 260, did not sustain. The short-term resistance is around 250, 55. If that breaks, it could be a big mean reversion move. And we've seen that happen in a lot of pharma names which have fallen a lot. So out here, expecting it to eventually break about 250 and head up towards 275, a stop loss to be kept at 239.
Positive on Biocon, that's a word coming in from Naresh as well. But let's focus on crude because that's one space which is seeing a lot of action at this point of time. Of course, overnight we did talk about that huge slide that the crude was seeing almost a 3 to 4% cut, and that meant that the closing levels were the lowest that we have seen since December 2021. Let's decode all of that with Ms. Vandana Hari, the founder and CEO at Vandana Insights. Thank you so much for joining us. Just wanted to begin with by understanding what's really ailing the oil prices at this point of time. Of course, there's that demand concern coming in from China. At the same time, the supply continues to be on the higher side. Where do you see all of this? How do you see all of this panning out?
Good morning. There is a lot to unpack here, but let me start with very top line comments, which is that amongst all the factors that are coming to bear on crude prices right now, I would say more of them are exerting downward pressure. And frankly, I see hardly anything that is capable of giving it a sustained and substantial upward boost. I suppose that's good news for consumer countries like India, other than perhaps a surprise additional cut by OPEC Plus, but that's not something that is at all our base case. Basically, what we're seeing right now is, as I mentioned, headwinds on the economic front. So the US debt ceiling drama was one of those. It's probably over now, but there's lots of others. The market is pricing in continued aggressive monetary tightening by the Fed, which means that most likely it could push the US into recession. Europe is not doing too well. And China, most of all, has disappointed all those who were hoping for a major rebound post-reopening.
Right. Vandana, hi, morning. Wanted to also get a take from you as to what the expectation is from the OPEC Plus meet that takes place on the 4th of June, because there are clearly right now mixed signals coming in by the major producers.
Mixed signals, yes, at the very least. I think there's also sort of contradictory motivations within OPEC. If you look at the two de facto leaders. Saudi Arabia, of course, the energy minister said again signaled again last week that they're not very happy with prices continuing to spiral downwards. And on the other hand, you have a major non-OPEC partner, Russia, and it's important for these two to stay aligned. But that could be difficult now going forward because Russia is in a very unique position now because of the sanctions. It's getting nearly 30% less for its oil exports than what it would have got in a pre-sanctions era. So Russia is not keen to implement any further cuts. In fact, it has not even fully implemented the cuts that it had promised of about 500,000 barrels per day. So a lot of conflicting positions within OPEC plus. But again, the bottom line is that it's been just a month since they announced additional voluntary cuts by 8 members other than Russia. So, they will want to wait and watch, see what is the compliance with those cuts. There's no point in promising more and more cuts if they're not even complying with the current ones, right? They'll probably want to formalize those cuts, but that wouldn't send much of a bullish signal to the market.
That brings me to the million-dollar question, Vandana, and that's where do you see the prices headed from here on? In terms of the near term, which is the immediate 1 to 2 weeks, and for the entire year, what could be the average?
So in the very short term, I think this debt ceiling, I was expecting slightly more of a relief rally, say until a week ago from the debt ceiling issue being resolved. I'm not that optimistic now. There may be a bit of a bump, but and the reason I've changed my position on that. So in the very short term, I expect a very, very small uptick, but not much. And the reason for that is I think the Fed continuing to keep a very aggressive monetary policy has become a major bearish factor on the markets. Continuing negative data from China, we saw overnight factory activity contracting for the second month in a row in China. So all of these headwinds combined are going to prevent much of a lift from just the debt ceiling sort of good news, if you will, on the market. Going out in the coming months, or looking out into the rest of this year, at some point, I think OPEC Plus will probably find itself cutting more. But, at that point, I think it will be more to just try and put a floor under prices rather than prop them up, let's say, into the above 80. Certainly, that is not my scenario at any point. I would say mid-70s probably average for the next 6 months.
Okay, mid-70s, that's the average that you can expect for the next 6 months. On that note, Vandana, we let you go. Appreciate you joining us to help us decode all that is happening and that is impacting the commodity prices at this point of time. Welcome back. Well, as we pointed out, the Asian markets have started on the front foot, so the levels for SGX have also improved a bit. At least it's now pointing that we are going to start around that 18,600 mark. But one sector which will be in focus today is definitely going to be autos. It's the first day of the month, and that's the day when we usually get the wrap-up of the month gone by of how the sales have really panned out. In the month of May, the expectation is that there might be a big drop when it comes to commercial vehicles, and two-wheelers might be a bit muted as well. Let's try and get further details with my colleague Shrishti, who's joining in.
Well, yes, you're waiting for the May auto sales data that will be reported tomorrow, but the expectation is quite muted this time around, a muted sales growth across the segment that we are expecting. But the key to watch will be the recovery in the two-wheeler segment, because what the reports are highlighting is that because of the marriage season, this particular segment is expected to catch up, and even the export sales data from companies like Bajaj as well as TVS is expected to see a single-digit growth uptick. Other than that, let's have a look at what the expectation on number is. For Bajaj Auto, we are expecting a 14% jump on a YOY basis, and for Hero MotoCorp, sequentially we are expecting a growth out there. For TVS Motors, the story says that on a YOY basis, that could be just a flat growth for this one. But for Eicher Motors Royal Enfield, a growth of 17% on a YOY basis, a number close to 74,500 unit is what we are expecting. Let's talk about the passenger vehicle segment, because over the months we have seen the demand holding strong, and a similar story expected this time. But in that, the CNG sales is picking up post the revision of the CNG prices in Delhi, and that could be a factor for a case like Maruti. And if we talk about the numbers this time for Maruti, a muted sales growth. If we talk about for companies like M&M as well as Tata Motors, a similar story is expected over there. Coming to the commercial vehicle segment, because in the month of March 2023, we have seen a lot of pre-buying. On the month of April itself, we have seen an effect of that, and that same story is expected for the month of May, wherein if you will see, then a good downfall on a YY basis is what we are expecting, and a muted growth on a month-on-month. And in the tractor segment, we are expecting that Escort sales could see a jump of 8% on a month-on-month basis, and even the share is doing well today. But on the flip side, M&M sales is expected to decline by mere 2%. So that's the expectation, but the key to watch will be the two-wheeler segment.
Thanks very much, Shrishti, for highlighting those details. Let's get a move on then. And with FY23 earnings coming to an end, let's look at what's in store for FY24. Which companies are expected to report the highest earnings growth and which are going to decline the most? Let's take it across to Somit, who's done all the data crunching and joins in with the details. Somit?
Well, firstly, we'll start off with those companies that are expected to report a profit in FY24 as against a loss in FY23. Firstly, the name is Indigo, and that is because of higher air traffic, higher ticket prices and lower fuel costs. If you see, the company's EPS is expected to come in at around 105 rupees in FY24. Then there is Aditya Birla Fashion. Now, there were some one-offs and in FY23. Along with this, there could be an improvement in demand and moderation in losses for the new businesses that would aid the company's profitability in FY24. When it comes to V-Mart, it is the recovery in same-store sales growth, turnaround in their legacy unlimited stores and moderation in LimeRoad losses would aid the profitability. And when it comes to HPCL, it would be the higher marketing margins and stronger refining environment that would aid the profitability. Moving on, let's look at the companies that are expected to report the highest EPS growth in FY24 now. Firstly on the list is Z Entertainment. Now in FY23, if you see, it was the weak ad environment, rising content cost and some one-offs that had marred the profitability. But these things won't be a part in FY24. Along with this, there would be a potential completion of the Sony merger that could also aid the profitability of the company. When it comes to cement companies like Nuvoco Vistas and Birla Corp, it is the higher cement demand, higher cement prices and lower costs that would aid the profitability. For Nike, it would be lower losses in the fashion and faster growth in the beauty segment that would aid profitability. And for Tata Motors, it would be the uptrend across JLR and India's CV and PV business and tight cost control that would bolster the company's profitability going forward. Now let's look at the companies that would see the sharpest drop in their EPS in FY24 as compared to FY23. Firstly on the list is Sapphire Foods. Now for Sapphire Foods, there were some one-offs in FY23 that bloated the profits. Now absence of that plus demand slowdown and higher raw material costs would impact the profitability. For Fine Organics also, it's a higher raw material cost and demand slowdown. For Oil India, it is lower oil prices and analyst expectations of some one-off related to service tax and GST provisioning that would impact the profitability. For Coal India, it would be the lower coal prices, higher wage cost, and for Laurus Labs, it would be high base, no big CDMO product in FY24, and lower margin expectations that would impact the profitability in FY24.
Somit, thanks so much for putting that into perspective. So that's the consensus call coming in from brokerages. Which are the stocks that might see the maximum amount of up moves and which are the ones which have the risk on the downside? But let's get you the fundamental opinion on that as well. Let's pick up one of the stocks that Dipan Mehta likes the most, that's Eicher Motors, and try and understand his rationale.
See, I think that there have been many challenges for Eicher Motors. Not now, I think last 3 to 5 years since we have seen the success of Royal Enfield. Many competitors have come, but they have not been able to make a significant dent. I think Eicher is miles ahead when it comes to competition in terms of launching new products. And what they are selling is a complete lifestyle, and they appeal to a certain class of consumers who are adventurous in nature. And that kind of a brand and that kind of aspiration can never be done by Hero MotoCorp or Bajaj. It's like any tier 2, tier 3 OEM trying to sell a luxury car. That just doesn't work. So I'm not that perturbed about any challenge coming from Hero MotoCorp or even Bajaj Triumph tie-up. The real threat for Eicher is going to be from the electric vehicles, because their main crowd also, the main consumers also are quite eco-friendly. And they care about the environment. So unless Eicher has a significant offering in the electric vehicle side, maybe 2-3 years down the line, that's when they'll start to face all the problems. But for the time being, I'm not too perturbed. I think that with the way they have expanded the distribution and the export opportunity available for Eicher, they should be able to sustain mid-teens type of growth for at least 3 to 5 years or so.
Let's also connect with Pankaj Pandey to get a sense on where markets essentially headed. And Pankaj, good morning. Thank you for joining us. Pankaj, while everything is looking good, Nifty is up 10% from the recent low, Bank Nifty double-digit gains. Are you a bit surprised that in this rally, Reliance and HDFC Bank have not participated at all?
So hi, good morning, Nikunj. Thanks for having me. So I think a couple of things. Overall, not surprised by the kind of rally what we are seeing in the market. I think our sense is that probably towards the end of this year, we might be heading towards 20,000 kind of a levels. Largely because last year's earnings have been 22% CAGR. Expectation is about 15% CAGR for next 2 years. So not major challenges we see from an earning growth perspective, given the fact that most of the bigger sectors, especially banking, are sort of firing all cylinders. Now, when you sort of look at stock specific, I think HDFC sort of declined largely because of technical factors. Otherwise, our sense is that this bank is also looking good. Here, our target price is 1970. And I think largely moves are expected once this merger completes. I think Reliance relatively has been sort of underperforming largely because of 2, 3 factors. One, I think when you look at GRMs, the GRM for Reliance is lower. So some of the PSU GRMs are at $15, the likes of say IOC, largely because they've been buying more of cheaper Russian crude, which is helping them to sort of deliver better, especially on the GRM. And I think the biggest segment for Reliance, which is retail, our sense is that retail has sort of done well last year, but what you are seeing is that you're not, in the metro, the demand is still sort of holding up, which is what you look at when you look at Shopper Stop or say trend numbers. But I think in general, retail is still looking a bit soft. And I think that is sort of driving the overall softness in Reliance. And I think most of your capex are still sort of panning out for earnings. The growth will happen, say, once this capex sort of comes on stream, which could be one or 2 years down the line.
There is which end of the banking cycle do you like? Corporate banks, mid-tier bank, PSU banks, or microfinance?
So what we like is, Nikunj, is more of sort of NBFCs. So we have started liking M&M Finance. I think one is, I think they are looking to double their book over the next 2, 3 years, looking to expand into newer geographies. So that is one stock which we are liking. The other thing is even L&T Finance. So our expectation is that you'll see good 30% plus growth over the next 2 years. And largely, most of the book is going to be retail. So there is a shift happening from wholesale to sort of retail. So upside there in these NBFCs look a lot more higher. Banks will sort of continue to sort of deliver well in line with the overall credit growth. So credit growth is still holding up 15, 16 odd %, and no major asset quality concerns. So that way, I think our sense is that banks will sort of keep doing, say, 15, 20% kind of a return, but NBFCs can offer more returns because valuation-wise, so for even for L&T Finance, I mean, while the ROAs could inch up to 2%, it's available at one-time book.
Okay, meantime, Pankaj, just wanted to also get in your take as to how you're looking at the auto sales numbers, given that we are expecting a bit of a cool off when it comes to two-wheelers. What's your expectation?
So overall, yes, we would expect a softer set of numbers in the PV side, largely because Maruti has been sort of highlighting the chip issues impacting. CV has sort of done well, so you have a high base, especially in the month of March, because of the pre-buying which happened because of Bharat Stage 6, Stage 2 norms. And I think two-wheelers is largely going to be okay. So that is the only sort of slightly better spot from a monthly perspective. But structurally, we still like the CV plus the PV segment more, because in CV, if you look at, most of the players have reported very impressive margins. I mean, including Tata Motors reporting 10% margins. So margin profile for all the players on the CV has definitely improved. So that is one space which we are liking. And I think PV will take its own sweet time to sort of improve. Probably after a quarter, because I think the volumes are still getting impacted because of chip supply issues. We like more PV and CV. We are very selective in two-wheelers, especially Eicher Motors. So that is the only spot which is looking brighter on the two-wheeler side.
Okay, so that's the only spot which is looking brighter on the two-wheeler side, Eicher Motors, and that was the view coming in from Dipan Mehta as well. But wanted to understand from you, Nuresh, as far as the entire pharma space is concerned, where do you see value? Because Nifty Pharma saw quite a bit of momentum yesterday. It's above the 200-day moving average. What are the top picks there?
So in pharma, what we are seeing is clearly the stocks which have fallen 40, 50, 60% over the last 1 year or even the longer term are the ones which are recovering well. The resilient ones like Dr. Reddy's, Sun Pharma, Cipla are not doing much. They're not showing any momentum. So out of the pharma pack, Lupin is the first one which comes into a bottoming out phase and has started a new trend, crossing about that 750, 800 mark. So out here, 750, 800 would be a zone to buy and eventually expect a move towards 1000. So that would be the first one. Second would be a buy on Biocon, which has again recovered back well above the March 20 lows and showing a mean reversal move. So that could be the surprise on the upside. Then there are a bunch of small cap names like Natco Pharma, which have created a bottoming out case. There's a Laurus Labs, which has created a bottoming out phase at 300, 330. So the overall bunch looks like Lupin, Biocon, Laurus Labs, Natco Pharma, more to do with the small cap names. Large cap, there is no momentum, although they are holding on. So would be looking at the small cap and mid cap pharma space.
Looking at small and mid cap names from the pharma space, but let's get you the fundamental opinion coming in from Sanjeev Bhasin as well. What are the top stock ideas? Listen in.
Electronics is a very sweet spot. Even electric appliances, look at Havells, look at Voltas. I mean, I can just give you the ancillary industries which are doing extremely well and where these are going to be part and parcel for the next few years. Railway stocks were always few weeks before the rail budgets and then they tended to die down. But look at the performance of RVNL or an Ircon or a Titagar wagon. It's telling you that the capex and the intensity with which the government is focusing on rail and in-road transport is humongous. That's why these companies' margins and their maybe the best ever in history. And I think they've run up a lot, so they've doubled, triple in the last 2 years. They can be caution and because they overown. Titagar and RVNL have been huge doublers from recent times.
Naresh, we have to discuss Zomato, 70 rupees yesterday. Is it headed towards 80, 90 or could it tumble back to 60?
So the target price for me for the stock was initially that 70, 75 mark, which is the top it made in the last 1 year. Time to book some profits and I would expect a pause from the 70, 75 band. This is the high in last June as well as in last December. Eventually expected to break that 75 mark as well and go towards 100. So now I would expect some bit of a consolidation where we get into a phase where it stays between 64 to 75. And then after a few weeks or months, we go into the next leg. But overall, the view remains the same. The longer term bottom is in place. The trend has changed and slowly and steadily it could be a stock which could go towards 100. So for now, in the near term, because it's made a good 20-25% move, the trade is where you book profits. Wait for either you book full profits or you book partial profits and ride on. But the medium to long term view still remains very constructive.
Well, I'll flip this question. Which are 3 stocks which, to your mind, Kunal, are nearing the end of the trend where you think things could reverse or they could hit a pause button? Kunal?
Well, as of now, frankly, Nikun, there are no signs of any kind of a major pause or a correction or an impending correction into these stocks because the way in which these stocks have rallied up is very slow, steady and staggered. So it's not been a vertical or an exponential move for these names. Specifically, the last 1 or 2 months have been very gradual in terms of an upward tick. Even if you look at, for example, the likes of Zomato, etc., these stocks have not gone through a parabolic rise. You've seen the last 3 or 4 weeks very slow, steady and consistent move. I think 3.5%, 4%, 5% kind of an upward tick on a week-on-week basis, and that's a very nominal kind of a rise for many of these new age stocks. So even the likes of Paytm, Policy Bazaar, and many of these other stocks, they've gone through a very slow staggered rise. Policy Bazaar specifically, the stock crossing that 600 mark, I think it's been almost 4 or 5 weeks that the stock has gone through a time-wise correction. So till the time you don't see a parabolic rise or an exponential kind of an upward move, it's very difficult to anticipate that whether these stocks would top out. Even if these stocks go into a pause, it would be more of a time-wise correction rather than a major price correction.
Pankaj, what's your view on the entire microfinance space? Of late, we have seen a meteoric rise in a lot of these names. Today, of course, Pandana Spurti is going to be in focus because our story seems to have been confirmed, wherein Ajay was telling us that Padmaja Reddy is looking at selling her stake. That seems to be confirmed at this point of time. But the other names, Fusion, 5-Star, Credit Access Grameen, is there any name that you would want to highlight?
So within microfinance space, we have a coverage on Credit Access Grameen. So that is one company which we like, and I think they have done relatively better compared to peers. And the parent also has been sort of in this business for a very long period of time. So from that perspective, I think this is the one space what we like. I think there the growth profile looks quite good. They're venturing into new markets. And I think overall credit cost, which used to be higher, I think is trending downwards. So that is going to sort of help this company. So Credit Access Grameen is the only and the top pick in the microfinance space as of now.
Credit Access Grameen that Pankaj is referring to as his top bet within that space. But it's been interesting, Pankaj, the way the real estate sector has shaped up. For instance, it was one of the top sectoral gainers for the month gone by. Are you very selective within this space or believe that there is a lot of opportunity in the sector as a whole?
So I think we are very selective in this real estate space, largely because one, the overall macro tailwinds are sort of turning better because we have seen 250 bips kind of a rate hike. So home loan rates have crossed 9% for most of us. I think that is sort of trending lower going forward with inflation not really sort of looking to sort of look higher. So that is one thing. And I think we are very selective in the space because what we like is something like Brigade Enterprises or Mahindra Life space. I think largely because of their selective exposure in some markets. So, for example, we are still not comfortable recommending Oberoi. I think Thane launch is still sort of pending and it's still into one particular market. So we are looking at companies or we prefer companies which are there into multiple markets. So accordingly, I think Brigade Enterprises looks best because I think they have very little debt on the residential side, which is what ideally it should be. And Mahindra Life has been sort of meeting the targeted land acquisition targets. So from that perspective, these two companies are the top bets in the real estate space.
Wanted your sense regarding a couple of these counters which might be in focus today, Gujarat Gas and GAIL. My colleague Somit helpfully points out that Saudi Aramco has cut the June propane prices sharply, and the new prices means that in July the propane would become cheaper by 17 to 18% versus prevailing Gujarat Gas Morbi prices. So looks like it's bad news coming in for Gujarat Gas as far as GAIL because it will mean lower realizations for GAIL as well. Naresh, a chart check going for Gujarat Gas as well as Gas Authority of India?
So Gujarat Gas has actually in the last few days made a constructive chart. The stock was trying to break out above that 500 mark. It broke out and say as of now the chart is positive. If some news comes in, we need to see the price reaction. Till the time it holds above 480, the view remains positive on the stock. GAIL on the other hand has got a lot of resistance around 110, 112, which is the previous all-time highs. And on the lower end, 100 is a support. So it's a range-bound stock for now. But Gujarat Gas looks more positive as such till the time it holds 480.
Have it. Those are some interesting picks from Naresh's stable. But moving right on, asset management companies, they've been under pressure over the past few months, even as the market sentiment is healthy. So is there a case to look at these stocks as a buying opportunity? My colleagues Sharad as well as Ashesha join in with the bull and the bear case scenario. Ashesha, let me begin with you. Which side of the story are you on?
Well, I'm on the bear side this morning, and let's start off with some of those points then. First up, let's not forget that SEBI has recently issued a consultation paper on the maximum fees that can be charged by these mutual fund houses. Usually, these all asset management companies earn yields anywhere between 2 to 20%, but because of the consultation paper that has been issued by SEBI, Nuvama says that their profitability could be impacted by as much as 27% by FY25. Let's also talk about the intensifying competition in the mutual fund space. We have a whole host of companies that have already received a SEBI nod for getting a license, for getting a mutual fund license. Bajaj Finserv, Navitech, Zerodha are some of those companies, and a whole host of companies have also applied for this mutual fund license, which includes the likes of Angel One, PhonePe, Helios Capital, Alchemy Capital Asset Management. Apart from this, let's also talk about some other regulatory changes that have recently come into place. Budget 2023 came up with a whole host of announcements. They proposed changes to the income tax laws pertaining to these mutual funds houses, and Nuvama says that it discourages inflows into debt, gold and international schemes by an estimate of about 10 to 20%. So some regulatory changes which are impacting the mutual fund industry. Moving on to long-term SIP redemptions then, and it continues to be a concern. In fact, 73% of the units in FY23 were redeemed within a period of just 2 years from their inception, and only 3% of the total investments that are done in SIP are redeemed or are kept as investment for a period of over 5 years, and hence SIP redemptions continue to be a concern for the mutual fund industry. Lastly, let's also talk about some other broader bear case scenarios. Front running continues to be an issue for the mutual fund industry. Apart from that, lesser incentives for passive fund management for most of these intermediaries is also a concern.
Well, yes, Ashesha, but let's look at the bull case also, how it actually goes around. And firstly, of course, is the valuations part. Of course, they are actually correcting from their one-year peak valuation. You see, they are still down between 15 to 25% in the listed space. That means valuations are attractive, what industry experts are stating. But there's also an increased surveillance coming in from SEBI. And of course, all eyes are there on the influencers, talk about misleading ads, and also the corporate governance issues which are being faced in certain fund houses. Apart from this, of course, the monthly SIP numbers are still above the 13,000 crore mark if you look at it, and this has been coming for the 7th straight month. That means strong inflows are coming across small cap, mid cap indices and funds for the last 3 months, and it's expected that this will be the 4th month as well, where we'll see strong inflows coming in. Apart from this, also TER changes, relaxation, which are actually pointed out. Over here, there are certain kind of, you could say, a deadline for submission of feedback that has extended, and also the reports are coming in that certain issues of TR which can be actually passed on to the cost to the intermediaries. That means it becomes slightly positive for the AMC companies. But there are certain industry growth triggers also, Ashesha, and that is something which is on a long-term basis we will look at, and this includes the AUM to GDP ratio. That's expected to go up, as well as the mutual fund AUM is expected to go up by more than 21%.
But the anchor change.
AMCs is concerned. Pankaj, let me bring you on board and get your view. Which side of the equation are you tilting towards? Are you a bull on asset management companies or a bear?
So when we look at some of these ancillary or subsidiary companies of banks, so our clear focus is largely towards bank, because see, we have tried insurance companies, we have tried AMCs, and also even credit card companies. I think the growth trajectory is still not very clear, and so that is where the challenge lies. So for example, in case of AMC, while the SIP inflows are good, we would expect earning growth to be in mid-teens, and that should help the market sort of or Nifty or overall market to sort of do well, and eventually leading to better AUM for most of the AMCs. But I think the challenges are still sort of there in terms of regulatory. So which is why I think if you have to sort of play, I think banks are a sort of a better bet. So I'll play it, say, through HDFC Bank rather than sort of playing it through individually through a HDFC AMC or HDFC Life. So I think banks, if I have to write that opportunity, I think banks are offering a slightly better option compared to sort of chasing individual names.
Duresh, where are some of these AMC stocks headed? I mean, if you're buying them right now, you're pretty much buying them at the lower end of the lower end of the cycle, or lower end of the range. Technically, do you think in HDFC AMC, Birla AMC, UTI AMC, is there merit in buying them?
So overall, if you look at the trend, is terrible, but a short-term bounce, yes, that is where it is possible. So for example, the best pick according to me technically comes out to be Nippon Life AMC. The stock corrected all the way to 210 levels in March 20, it went below those levels. Now recovered back to 240, made a consolidation, sideways consolidation for almost a couple of months. And now the breakout has taken place. So this could go towards 275 to 290 levels. But that is where I think there is a pause. So a 10 to 20% max upside from here on in most of these AMCs, and they'll start getting a lot of resistance because the longer term trend is still down for most of these names. It's just that the stocks have corrected a good 50% in a lot of cases from the top. So small bit of recovery would be normal. So for example, UTI AMC was 1200 rupees, where it spiked up to, then went to 650. Now going back to 800 would just be a normal move, but can it be sustainable? Looks very difficult.
Pankaj, which is one commodity end of the market you are excited about? Sugar, steel, tea?
So Nikunj, I think from a commodity perspective, we're positive on two things. One, cement, because I think the benefit of lower coking coal prices or coal prices will start reflecting from Q2 onwards. Most of your tier one companies have reported very impressive volume growth. So that is one space which we are sort of liking, which should benefit from the overall commodity decline. The other is the autos, because autos in general will benefit from that. One more thing, if I want to sort of highlight, is probably the gas price. Now, with the tile companies, their margin.
Yeah, go ahead, Pankaj. There was a bit of an audio issue, but go ahead.
So another segment which we like is the tile manufacturers. Volume growth is expected to be 12-13%. We have seen gas prices correcting, and most of these players have yet to sort of witness peak margins. So, for example, Kajaria, the peak margin used to be about 20-odd%. We are still looking at 16% kind of a margin in terms of our numbers. Volume growth is good because Morbi players are largely exporting and not really sort of dumping domestically. So price discipline is also sort of better. And I think overall real estate as a segment is also sort of shaping up well. So I think this is one space where we like both Kajaria as well as Somani Ceramics.
Okay, there you have it. Those are some interesting recommendations. Meantime, Naresh, wanted to get in your take on the charts. Campus Activewear saw a breakdown in yesterday's trading session, and ditto was the case with something like a Sri Renuka. What are the charts indicating here?
So Campus looks very weak, and say it's very critical that it holds around the 290 mark. After the IPO, the stock was trading around 300 to 380 levels. So 300, roughly 295, 300 was the bottom. Went up to 640. Again, back in March of this year, the stock made a bottom around 310 levels. And now we've come very close to that 300 mark. So this is a very important support. So if it stays below that, it becomes much more weak. There is not much data beyond this last 1.5 years. So in this case, 295, 300 is a critical support. If that breaks, we could see some more correction. Renuka Sugars, similarly, if you look at it for the last 1 year roughly, 40 is the mark, which is a support. We are at 42 now. So 40 should ideally hold. If it breaks 40, then the trend changes. So for now, both of these names are in downtrends and coming very close to critical supports. Would not preempt whether it should bounce from here.
Take coming in on one of the sugar companies as well as Campus Activewear. So those are the stocks and the recommendations coming in from the race at this point of time. But let's get those mid-cap strategies also out of the way. Kunal, what are the top mid-cap bets?
Well, I'll suggest a buy on ABFRL. That stock has been beaten down significantly, I think at 200 odd levels. Looks attractive for a contra bet from current zone. Indicators are showing signs of bullish RSI divergence for ABFRL on the hourly chart time frame. So I think that's an indication that possibly the worst could be behind for the stock at least over the near term. 216 as a target for ABFRL and stop loss at 194.
Suresh, what about you? What's the top mid-cap strategy?
So that would be a buy on Spandana Smurti Financial. The stock has given a good price volume breakout. The volumes have increased over the last 2 weeks. Yesterday was a clean breakout above that 700 mark, which is a resistance. Longer term trend also changing, and the whole MFI NBFC space looks very interesting. So a lot of these names are popping up on breakout charts. It started with Ujjivan and Equitas, but now we are seeing a lot of other names as well. So Spandana Smurti looks like a short-term breakout done. Yesterday's low at 680 will be a stop loss and a target price of closer to 800 plus in the near term.
Let's get a move on then and tell you about some of the other top stories that we're tracking. And Tesla chief Elon Musk has once again topped the list of billionaires, surpassing luxury brand tycoon Bernard Arnault. Musk was in stiff competition with the 74-year-old Frenchman for the top spot this year. Do remember, Arnault first surpassed Musk in December last year as the tech industry struggled and luxury showed resilience in the face of inflation. Meantime, Johnson & Johnson faced its first trial in almost 2 years over claims that the baby powder contains asbestos particles, which is a cancer-causing element. This comes amidst the company's efforts to seek a settlement in thousands of similar cases in the bankruptcy court. And smokers in Canada will soon buy cigarettes with warning labels on each stick. The country will print labels directly on the cigarettes itself, and phrases like cigarettes cause cancer and poison in every puff will be used. This comes amid efforts to reduce tobacco use in the country to less than 5% by 2035. Meantime, the Rajasthan Chief Minister Ashok Gehlot announced the free electricity policy for the state. Up to 100 units and a fixed rate from the next 100 will be made available to the people. This is one of the big announcements that have been made since December last year, when he promised huge subsidies on cooking gas.
And the latest coming in from the violence-stricken Manipur, where Union Minister Amit Shah is on his peace mission visiting relief camps where dozens of houses were set on fire and gunfights raged between militants and security forces. Remember, Amit Shah is scheduled to hold a press conference today at 11 a.m. on the matter. Meantime, Defence Minister Rajnath Singh commented on the ongoing restless protest, stating that the probe is on against the WFI President Brij Bhushan and action will be taken once the investigation is over. Well, once again, the Kuno National Park is set to welcome 7 more cheetahs, which includes 2 females, into the wild by mid-June. Remember, last year, Prime Minister Narendra Modi had initiated this endeavour by releasing 8 cheetahs from Namibia, among other 3, amongst which 3 have already died this year.